Max pain theory in options. What is it? We're going to talk about exactly that. We're going to start with what it isn't, then what it is, then how you can use it. What's up, everybody? Erik here. Welcome back to All the Outliers. A shout out to the Patreon family. You guys make creating content like this possible. And if you enjoy my content, consider signing up. It helps me out a bunch. So as per usual, I want to start with what it isn't. And if you're like me and you were playing video games in the late 90s, early 2000s, you would think it's this dude, which is kind of like OG to the Taken guy. It's the video game where his family was killed and he was an undercover detective. That's not the max pain we're talking about today. Next, we have that feeling you have in the bottom of your stomach when you open up your portfolio and this is what you see, where you're down 94% all time. That is also not max pain, although both technically are also max pain. Let's talk about what it actually is. So first off, I want to start with kind of a quick definition from Investopedia. You can read that at your leisure. I'm going to summarize it for you because, I mean, that's what I'm here for. And essentially, it's the strike price in an individual series, meaning an expiration cycle, where the most options expire worthless. Why does that matter? Well, there's a couple things that lead into that. The first being this bullet point right here. The assumption we start with is that on the counter side to most purchased options are market makers. They're the people that typically make markets. So if a lot of people are buying options, they're typically selling options. And there's a reason why this is important. It's because market makers tend to hedge their positions so they have the ability to move price, at least somewhat. But those same sellers, they would much rather the options they sold expire worthless. It's just a simpler transaction for them. They don't have to move any inventory. There's no weekend risk, anything like that. So the theory in general is market makers are the vast majority of sellers out there on the open marketplace. They would prefer their options to expire worthless. So come expiration day, they are then incentivized to quite literally manipulate the price of the stock to land at maximum pain. And I'm going to show you exactly how to find what that looks like. On the left-hand side over here, we have the calculations for it. There's a lot of websites that do it for you, but I'm also just going to show it to you in Thinkorswim because that's the platform I use. And then I'm sure you can find a proxy if you use any sort of regular platform, cough, probably not fucking Robinhood. But other than those dorks.
But come on, man. You had one fatal flaw.
Robinhood.
Such a dork.
Most things will give you a proxy for maximum pain, although they may or may not call it that. And I'll show you what that looks like in a second. But first, let's understand how it's calculated. What we need to do is understand the series value for all of the individual strikes in an expiration cycle. So what does that mean? Well, if we pop open the platform here, let's say we're going to go to the 25 July expiration. And typically you want to use the closest expiration. It's really prevalent on expiration date itself. But because I'm filming this over a weekend, there is no 0 DTE available right now, but this will serve as a proxy. Essentially, what we need to do is see where the vast majority of option value exists. So there's two things we have to look at. One is the open interest, which is this column. And then we have to look at the intrinsic value because essentially that would be the value if it expired in the money. So you do that for all of the options. Again, there's a simple way to do it. Don't worry. I'm just explaining how it's actually calculated. Once you get the value for all of the options in that chain, then we understand the series, the expiration cycle value. And we need to find the specific strike price where the vast majority of the greatest value as a dollar amount of options expire worthless. That's the maximum pain strikes. Get it? Pain strikes. I hope somebody picked that up. And then down here, like I said, it does become more pronounced when expiration cycle gets closer. And that's because that's when a lot of hedging is happening. And again, this comes into play at expiration when the options are about to expire. So we talked a little bit about what it's not. Now, hopefully we have an idea of what it is. But before I show you exactly how to find it in the platform, I want you to take a look at this study. Not going to go through it in detail here. You are more than capable of looking this up on SSRN. As I always say, you shouldn't take my word for any of this stuff. I'm literally just a dude that talks on the internet like all the other finance content creator YouTubers. We are just people sharing anecdotes, essentially. I have a really comprehensive data set on this actually, but mine's not peer reviewed. This is. And this is actually a pretty recent study. This is from 19 November 2022. And it says, no max pain, no gain. Stock return predictability at option option expiration. And there are some actually really interesting bits in here. So I've highlighted those for you, but let's take a look. This says we construct a measure of potential max pain gain loss, sort stocks according to this measure, and find that a spread portfolio that buys high max pain stock and sells low max pain stocks generates large positive and statistically significant returns and alphas. So essentially what that entire line means, if you're new to reading these kinds of things, it means that there's an observable tradable trend. Then down here it says our results provide strong evidence of stock return predictability at the expiration of options. We find that these returns reverse after options expiration. That's super important because this is talking about stock manipulation. The fact that it happens at expiration but then reverses post would definitely be indicative of some sort of market force causing that movement. And then the last thing here, this is probably the most important thing because I can already see the dollar signs lighting up in your eyes, but it says our results are especially strong for relatively small and illiquid stocks. So all of the people that are out there trading 0 DTE options, I will tell you that there is some semblance of it existing, but it's very difficult for those to be moved. Index like SPX or even SPY, there's a lot of money in those indices. So now let's take a quick look on how we can find it. So for example, what I'm going to do is pull up some options product depth details. And right now I have it set to show me the average. So this is combining calls and puts into one individual chart for me. It's easier to see. The other thing you'll notice over here is I have intrinsic value. So if we go back really quick and we take a look at, if you'll recall the calculation, we need to calculate the intrinsic value. So that's exactly what we're doing here. I'm finding the spot where the intrinsic value is actually the lowest because again, that will tell me that that's where maximum pain lives. So if we take a look at this graph, we can change it to be whatever series you want. You want to isolate whatever expiration cycle you're looking at. So going off of this 25 July series, we can see that maximum pain is right around 45.32 is what I would say. Options, it has to move in the full strike price. So even though this will show you, distances between strikes, meaning it goes from, 4,400 and then it has decimal point. The strikes don't have a decimal point. So you just round and you get kind of the closest idea that you have. Based on what I'm seeing here, it's right around like 45, maybe 30. Yeah, it's like somewhere right around 45, 35, something like that. And what this is really showing us is if I actually change this to open interest, we can find the strikes where there's a lot of depth. And realistically, you would want to do it for calls and puts so that you can get an idea on, where that strike might live. But we can see, again, pretty simply, if you just use this tool over here, that we can see the intrinsic value. And again, we want it to be combined. If it's not combined, it's kind of more difficult to find. Now, let's take a look at what this looks like in practice. I actually went into Thinkorswim and I ran this in on demand. So this is kind of the tool where you can look back in time. And so this is one clip. I think this was from 2018, March of 2018 is when I went back to in time. It's just a random day. So I went to the open of the day there and it was 275.87 in SPY and maximum pain at that point in time was 276. I want to show you something. This is at the end of the day. This is right after the close. It closed at 278.76. Maximum pain was then 278. What happened? Eric, you just said at the open of the day it was 276, but then it was 278. Alas, markets move. They don't stay static. That's actually one of the issues with using this as a strategy is some people believe that once you understand maximum pain at one point in time, that you're good, that you're set, you know where it's probably going to get pinned to if it's likely to get pinned. But the problem is options move. The vast majority of options, 60% of them are traded before expiration. It's an important figure because what that means is this isn't a static data point. If you want to try to use this, it typically is a little bit more effective to be closer to actual expiration. And then the other thing is, depending on where maximum pain lives, if we're 10 points off of maximum pain, probably not going to trend to maximum pain. That's a really difficult leap to make because again, it's really important to remember that if we're very close to maximum pain, it is entirely possible for market manipulation to occur so that market makers can just bump price just a bit. And that's what that study indicates observing. So is this the silver bullet? You now have the secret recipe to making money in options? Unfortunately, no. You're still going to struggle like the rest of us, but this is an interesting phenomenon. So my suggestion to people is if you're interested in this kind of stuff, track it. Take a look at it for the next few weeks going forward. With things like SPY and SPX, there's an expiration nearly every day. So you could do this. You can create a data sample like really quick now with all the expirations available to us. And you can see, does it trend to this or does it not? And then you can start to think about different trade hypotheses that you use around that. So for example, personally, I like to trade 0DTE, SPX, short straddles, sometimes iron flies, and I purposefully wait until later in the day, and I will look at maximum pain. That's not the center of my universe for the trade, but it's an additive input, because then if I realize that we're a couple points off of maximum pain, I might tend to move my strikes a little bit or wait a little bit longer until I kind of get some confirmation if we're moving in that direction. It's the kind of thing that there is efficacy behind it, but this isn't going to fix all your problems. So if you have any questions, any follow-ups on this, let me know. Don't forget to like, subscribe, join our Discord. It's completely free. Be an outlier, and I'll see you guys later.